Headlines just screamed peace. The president announced a ceasefire. Instantly, the markets reacted exactly how the algorithms were programmed to react. Oil crashed. Tech stocks surged. Retail investors breathed a massive sigh of relief, convinced that geopolitical tensions were finally cooling down. But if you look closely at the charts, something completely broke the matrix. While the masses celebrated the peace story, gold surged 3%, silver exploded 7% in a single trading session. And behind closed doors, away from the screaming headlines, China quietly added another 500,000 ounces of gold to their central bank reserves. Stop and ask yourself, if peace is truly here, why is the world's most powerful Eastern superpower hoarding precious metals at a record pace? The smart money is not buying this peace story for a single second. They are buying gold, they are buying silver, and they are doing it aggressively. In this video, I'm going to break down exactly why this so-called ceasefire is actually a calculated setup. I will show you what the 53-year gold chart reveals about exactly where we are in this macroeconomic cycle. And I will reveal one shocking chart that proves why silver is primed to outperform tech stocks by 30 times. You see, the mainstream financial media thrives on short-term memory. They want you to focus on the immediate dopamine hit of a green day. They point to the S&P 500 index rallying as proof that everything is completely fine. But wealth preservation does not care about promises. It cares about mathematics, supply, and demand. For the past 24 months, while regular people were glued to the news cycle, the largest institutional players on the planet have been orchestrating a stealth accumulation phase that defies all conventional logic. When a major international conflict supposedly pauses, traditional safe haven assets like bullion are supposed to sell off. They are supposed to bleed capital as risk appetite returns. Instead, we witnessed the exact opposite. The moment the ink dried, industrial silver demand skyrocketed. Physical inventory across major global exchanges vanished into private vaults. This is the ultimate signal. The institutions are using the distraction of global diplomacy to reposition their portfolios for a monetary crisis that cannot be stopped. They understand that fiat currency debasement is the only mathematical certainty left. I need you to pay very close attention for the next 15 minutes. Turn off your television and block out the noise. We are going to look at the raw data that Wall Street purposefully ignores. We will examine the historical precedents, the central bank balance sheets, and the undeniable supply shock hitting the commodities sector. By the end of this video, you will see clearly why the current economic narrative is nothing more than a carefully constructed illusion. How you can position yourself on the right side of history. Let us dive straight into the hard numbers and expose the truth. The real crisis has only just officially begun. Time is running out extremely fast. Are you ready? Let us begin. To understand the deception, we have to look past the political theater and look straight at the liquidity. Wall Street wants you to believe that geopolitical peace means economic stability, but the ceasefire is a smokescreen. The underlying crisis has nothing to do with borders and everything to do with debt. Sovereign debt is spiraling out of control. We are staring down the barrel of a multi-trillion-dollar deficit that requires infinite liquidity to sustain. When the ceasefire was announced, the sudden drop in oil prices gave central banks the perfect excuse to quietly pivot. Lower oil means lower headline inflation. This gives the Federal Reserve the green light to quietly slash rates. They fire up the printing presses without causing a panic in the bond market. The smart money knows this. Institutional billionaires know that currency debasement is accelerating. That is why they use the temporary dip in the dollar to buy physical assets. The peace treaty is temporary, but the destruction of fiat purchasing power is permanent. This is the exact setup we saw right before previous historical wealth transfers. Look at the broader macroeconomic picture. Too money supply is expanding again. We are talking about trillions of newly created dollars preparing to flood the global system. You cannot create that amount of artificial wealth without devastating consequences for the purchasing power of the average citizen. Global central bankers are now completely trapped. If they keep interest rates elevated, they bankrupt the government. If they lower rates and print money, they destroy the currency. They have chosen to sacrifice the currency. This is precisely why a sudden drop in oil prices is a massive red flag. The algorithmic trading bots and novice day traders see cheap energy and immediately bid up overvalued risk assets like technology equities. But the institutions see something entirely different. They see a brief window of opportunity. This allows them to dump depreciating fiat currency into hard, tangible commodities before the masses wake up to the reality. Consider the historical context. Every single time a major global conflict reaches a supposed resolution while national debt is at record highs, the subsequent economic policy always defaults to aggressive currency devaluation. The politicians take credit for the peace, and the central banks quietly monetize the debt accumulated during the conflict. It is a playbook executed for 100 years. Therefore, the surge in silver and gold during this supposed moment of peace is not an anomaly. It is a glaring warning sign. The financial elites are front-running the inevitable wave of inflation that will follow this temporary period of calm. They are acquiring physical bullion because it is the only asset class with no counterparty risk. When you hold a bar of silver, you're completely outside of the banking system. You are immune to the algorithmic manipulation and the political promises that inevitably fall apart. This ceasefire is nothing more than the calm before the ultimate monetary storm. Now let us transition and look closely at the specific historical chart that absolutely proves it. Let us pull back and look at the 53-year gold chart. This is the timeline that Wall Street prays you never study. 53 years ago, the dollar was completely severed from gold. Since that exact moment, we have seen distinct, violent cycles of inflation, followed by massive revaluations of precious metals. On this long-term chart, we have just broken out of a multi-decade cup and handle formation. This is not a standard technical breakout. This is a paradigm shift. Look at the volume nodes right here. For the past 24 months, while retail investors were distracted by chasing artificial intelligence tech stocks, central banks were accumulating physical bullion at levels we have not witnessed in over half a century. They are front-running the inevitable collapse of the debt supercycle. When gold breaks resistance on a 53-year timeline, it does not stop after a 10% gain. It enters a parabolic price discovery phase. But here is the critical part. While gold is the ultimate wealth preserver, it is not the trade that will create generational wealth. For that, we have to look at gold's volatile, unhinged younger sibling. Look closely at the year 1971. That was the exact moment the gold window was permanently slammed shut. Before that year, a single ounce was pegged at $35. Today, it is trading in the thousands. That is not gold gaining value. That is the fiat currency completely collapsing in purchasing power. Every time the government creates a new crisis, they solve it by printing more currency, which guarantees prices must adjust upwards to reflect the new money supply. For the last 13 years, gold has been silently building this massive cup and handle consolidation pattern. The handle formed precisely during the fastest interest rate hiking cycle in modern history. Wall Street analysts predicted high rates would destroy gold. But what actually happened? Gold completely ignored the Federal Reserve. It ignored the highest real rates in 20 years. Why? Because the sovereign wealth funds and Eastern central banks stepped in and bought every single dip. They are not trading paper contracts. They are demanding physical delivery. They are pulling thousands of tons of metal off the global exchanges and flying it back to the East. This is a massive drain on Western liquidity. When the media tells you to sell, they are providing exit liquidity for institutional players. They want you out of hard assets and back into an overvalued, fragile, tech-heavy stock market right before the next major liquidity crisis hits. The 53-year chart is screaming that the fiat system is reaching its mathematical limit. The Global South is establishing parallel payment systems, completely bypassing the dollar network, using gold to settle trade deficits. This is the de-dollarization thesis playing out in real time. When the ultimate safe haven asset breaks out to all-time highs, while the stock market is also at all-time highs, it is an anomaly. Historically, they move in opposite directions. This concurrent surge tells us that capital is terrified, hiding in anything offering protection from debasement. However, as explosive as this gold breakout is, the barrier to entry is massive for the average retail investor. Buying an ounce requires thousands, and while gold will absolutely protect your purchasing power over the next decade, it is fundamentally designed to preserve existing wealth. The true asymmetric opportunity, the real asymmetry that the hedge funds are whispering about right now, is found in the gold to silver ratio. The historical relationship between these two metals is completely broken, and when it snaps back, the violent repricing will shock the world. We must now carefully examine the exact details of this shocking chart before the perfect window of opportunity is closed forever. This brings us to the most explosive asymmetry in the entire financial market today: silver. As I speak to you right now, silver is facing a massive structural deficit that is mathematically impossible to resolve without a violent repricing. We are talking about an asset that is completely exhausted on the supply side, yet critical for the green energy revolution and military defense. The world is consuming hundreds of millions of ounces more than the mining industry can pull out of the ground every single year. But I want you to forget the industrial demand for a moment. That is just the baseline fundamental floor. This is the ratio of the technology stock index compared directly to the price of physical silver. Right now, technology stocks are trading at atmospheric, historic bubble territory valuations, while silver is still priced like it is the 1990s. The divergence is absolutely staggering. We have an entire generation blindly indexing wealth into a top-heavy stock market, unaware of the erosion beneath. Now, let us look at the historical reversion to the mean. Markets always eventually snap back to historical averages. If the capital in overvalued tech equities rotates even slightly into the tiny physical silver market, the price will not just double or triple. According to this ratio chart, Silver is primed to outperform technology stocks by 30 times. You heard that correctly. When the algorithmic tech bubble finally bursts and institutional capital seeks a safe haven, the exit door will be far too small. The global silver market is tiny compared to the multi-trillion-dollar technology sector. It is like forcing an entire ocean through a garden hose. While the retail masses are distracted by headlines, the true apex predators of finance are aggressively draining the commodities exchanges. The vaults in London and New York are quietly emptying. The mechanism of paper suppression is finally breaking apart. Once that paper suppression mechanism completely shatters, silver will gap up so fast and violently that retail investors will never catch the train. This is not a conspiracy theory. This is basic supply and demand combined with the terminal decline of a fiat currency system. During the 1970s, as inflation ravaged the dollar, silver went on a spectacular run, multiplying in value exponentially. The 30 times moonshot is a virtual certainty if you understand capital rotation. The only question is whether you will be positioned beforehand. Do not let them steal your financial future. Now we must prepare for the final phase. Do not let this macroeconomic fake-out blind you. The mainstream ceasefire narrative is carefully designed to keep the general public completely calm while the global financial elites secure the lifeboats. Watching oil crashing and technology stocks surging provides the absolute perfect illusion of stability. However, the real undeniable truth is written in the aggressive actions of Eastern central banks adding another 500,000 ounces of gold to their massive vaults and silver exploding 7% on a trading day when geopolitical fear was supposedly dead. The 53-year macro cycle is converging. The global sovereign debt mathematics are fundamentally broken. And the window to successfully position yourself ahead of this 30 times wealth transfer is closing incredibly rapidly. If you found this independent deep dive valuable, hit the like button right now so this critical warning breaks through the algorithm. Subscribe to the channel immediately for more unvarnished truth that Wall Street desperately tries to hide from you. Protect your hard-earned wealth, and I will see you in the next video.